Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today for today's podcast. We have a whole list of data to get through, news headlines to talk about. So welcome back. And for first time viewer, thank you for your viewership. Please like, share, and subscribe to Shepherd Wealth Management Podcast. I got a lot of stuff to talk about today. And it's going to be a lot of fun with some more news coming out here after the market closes today at 4 o'clock, right in the thick of earnings season. Biggest week of earnings is right now. It's been nothing but fantastic, and expect more of the same here, not just tonight, but for the rest of this earnings season. And if you're a regular viewer of the Shepherd Wealth Management Podcast, thank you again for joining us on this Thursday. The main reason why we can continue to show up here about every 2 weeks to deliver this particular program is because there's a lot of news going out there. All y'all get that information on your smartphones pretty much instantaneously these days. And that drives a lot of emotions for investors, either in a good way or a bad way. A lot of the news tends to be in a negative headline space. Most of that has to do with the fact that the news is a for profit business. They're trying to capture your attention so they can sell ads. There's nothing wrong with that. I am a capitalist and for-profit person, but the issue is we all have busy lives, a lot of stuff going on. We catch the headline that drives our emotions. Usually, it's fearful, and the reason for that is news understands human beings and behavioral finance, and that study has shown that humans feel emotional losses twice as much as they feel good about making a profit, which makes us risk averse by nature, and we're twice as engaged when it's a more fearful headline. So therefore, if you're more engaged, that's generally why the headlines are more fearful, is because if your viewership is twice as engaged, well, they can sell ads more effectively at a higher price. And that's why you get that information. But here at this program, yeah, you do get the information. We're going to talk about some of these headlines today, but what we're also going to do is say, hey, here's what history has to say. Here's how other human beings that participate in the market have behaved under very similar circumstances. And here's what the market kind of looked like 6, 9, 12 months later. It starts to put things in the proper perspective. We found a ton of success for that for our customers over the last 4.5 years. Shepherd Wealth Management has grown from a startup firm to over $155 million in assets that we manage for customers across about 19 states at the moment. Picked up another state in Wisconsin here recently. So we are a fast growing registered investment advisory firm. And the reason for the success has very little to do with me being able to read a balance sheet and an income statement and cash flow information better than the next guy or gal. But what it does have to do is we've crafted a process that removes the biggest hurdle that individual investors have. So according to Warren Buffett, the best investor of all time, and if you don't believe that, just check his track record from 1965 to now. 20% average return, where the market produced a 10% average. And a lot of stuff has happened, good, bad, and indifferent. A lot of different political things, wars, you name it. It happened during his tenure at the helm of Berkshire Hathaway. And he famously said the number one reason individual investors do not achieve the results that they're looking for consistently over time is they have no process to control their emotions. He calls it temperament. And we found a way to do that here for our customers at Shepherd Wealth Management. And once we can remove that hurdle, risk and reward becomes very clear. It's not perfect. Of course, past performance is no guarantee of future results, and investing does involve risk, including risk of loss for all those compliant hawks out there. But we're going to get into some of that today. But before we do, I got a chance to go to Great American Ballpark last night and catch the world famous LA Dodgers lose to my hometown Cincinnati Reds. So it was nice to not get swept by the Dodgers because we did lose the first 2 games of the series. But I wanted to go last night. I got to see the $700+ million man, Shohei Ohtani himself, pitch. I think his second start probably since he had the Tommy John surgery or whatever was going on with his shoulder, elbow. I'm not for sure. But anyway, he was throwing the ball real hard. He looked really good, but the Reds did a little bit better. So that was a lot of fun. And it was a packed house, even though it is late July here, last day of the month, smoking hot in the Midwest. And but that 90-degree heat, you get about 90% humidity. So it was sticky, but packed house, a lot of fun. And I got to bring my 6-year-old with us to the game, and she had a blast. Probably ate way too much candy, popcorn, ice cream. But what are you going to do when you're 6 years old? That's what you do. So yeah, it's been a great summer. Anything coming up for you as we turn the page into August, 7 months in the books.
Nothing but an existential dread for where the time has gone and how am I going to beat this heat? Yeah, I'm also still currently in Nashville, and we don't have quite the humidity, but it's been brutal. Heat indices, way above the 110, and um, a couple weeks ago, we had a bunch of rain come in, and it was like it's going to break the heat. So instead of it being 98, it was 93,
Yeah.
which was nice. But looks like we're going
Yeah.
to get some relief this weekend. So that's
Needed.
really it. Just I'm on my grind, as they say. So
Yeah, yeah. We got a couple weeks before school starts. I know all the parents out there, specifically the moms. I know my wife is looking forward to getting kids back in school, give a little bit more time back in her day. But all that stuff can wait a couple more weeks of summer here, at least for us in our household. But today is going to be hot with a lot of data. So we're going to start with some cool stuff here. I mean, last night's earnings after the bell, we had two tech giants reporting: Facebook, otherwise known as Meta, and Microsoft, and their earnings did not disappoint. So I want to cover that, and then we'll continue the earnings conversation as we get through the rest of today because we got another big one coming up on tap tonight. So we'll talk about that too. But let's start with Meta. So Facebook, they've been killing it. I mean, I don't know what else to say. If you have not been participating as a shareholder in this, I still don't think if you're a long term growth investor, comfortable with individual stock exposure and the risk involved with all that sort of stuff, certainly do your own homework. No recommendations are coming from me to this audience today. I only make recommendations for customers who I know very, very well. But if this is something that you're still looking at, I mean, just check this out. Q2 earnings surprised Wall Street big time, which sent Facebook's stock, otherwise known as Meta, up about 12% as I'm delivering this information here right now. So Facebook revenue, 47.52 billion. Analysts were looking for 44.3. I mean, they smoked it. Um, and of course, they're looking at the AI investments as the main driver of a lot of those revenues, which is clearly helping their stock price today. Now, the earnings per share based on that revenue, analysts were looking for $5.89 of earnings per share. Meta delivered $7.14. So again, just top line domination, bottom line domination, and that is with major spending. I think all the news captured all the spending that Meta has done very well. They've invested very heavily in their AI labs division, and that involves acquiring talent as well. So human talent investment went up dramatically. We'll see how that plays out into their future earnings, but so far, the investments are definitely paying off in a very big way, sending their share price to all-time highs. One of the other things that we had talked about in a prior podcast as was the AI Ray-Ban. That actually showed up in the earnings report here. It did accelerate some revenue, and that revenue did increase 5% from their Reality Labs division. So I don't have a pair yet, but I do want to try them out, and they look cool. I'm not exactly sure what benefits and features they provide. So again, I've not tried the product myself, but we did talk about it. I don't know, a couple podcasts ago or so, and I thought that stood out to me in their earnings report. So we'll see how that accelerates. Definitely going to be something I'm tracking
yeah,
as a
same. I didn't
shareholder.
realize that was going to be affecting their, like you said, their earnings so soon. Especially I don't think we've seen a prototype yet. They just kind of announced the plans for it.
Yeah. So also on the advertising front, uh, Zuckerberg, first of all, before I get to the advertising front, on the glasses, he said this quote, the ideal form factor for AI, echoing his vision he outlined in a letter that he sent out to shareholders, that personal super intelligence piece of this particular product, I guess, is what's helped driving some revenue. Because they do have sales of those AI Ray-Bans. So it's not just prototypes anymore, according to this
Oh.
Business Insider article
Is that
that
is that
covered.
saying it's a pre-order, or do people actually have like physical copies of it?
It doesn't say that. It just says the company. This is coming from Business Insider. This is a article written post Meta earnings yesterday. Um, And it says the AI Ray-Ban sales, of which are accelerating, quote, uh, helped drive revenue increases of nearly 5% of the Reality Labs division. So it's not saying that the Ray-Bans itself drove 5% of the Reality Labs revenue, but it did participate in it. And it was called out, which is why I'm talking about it here today, because we did notice that not that long ago. And I thought it was pretty cool that they were rolling that out. And it seems to have some impact, but we'll see what greater impact it may or may not have in future earnings.
Yeah, that's rad. We won't have to go down that conversation we had again. Like you said, it was just a couple episodes back. But one of the things that made the iPhone so impressive early on was that they opened it up to third-party apps, and I'd be interested to see if Meta is going to do that with their glasses, because that's not something that their hardware has been known for. I mean, obviously the Meta Quest, you can buy third-party games, but if they allow third-party apps for that, you're going to see it really take off and be something really that people are interested in. So.
Yeah. On top of that, Zuckerberg continues to be quoted in this particular article that I'm reading. And this was written about 18 hours ago. Again, Business Insider article. Zuckerberg on the glasses quote: "I think in the future, if you don't have glasses that have AI or some other way to interact with AI, I think you'd probably be in a pretty significant cognitive disadvantage compared to other people." Zuckerberg says. He goes on to say, "quote Glasses will be the ideal way to blend the physical and digital worlds together." He predicts, mentioning the metaverse. So we'll see. I mean, this is all brand new stuff, right? I mean, they're heavily investing in tech and AI and coming out with products and other services that hopefully continues to drive revenue for shareholders. I mean, that's the whole point of all of this. And right now you're seeing that, which is great. Obviously, it's a big win for Meta shareholders, big win for our customers here today. And I'm very, very happy to be a shareholder of their stock. And I don't expect too much difference here. I mean, my big thing with these guys is sometimes they tend to overspend and they have to reel that in. They typically have some layoffs and they don't spend so much for a little while. So we'll see. Right now, that spending is definitely paying off. So that's the bottom line here for shareholders. If they are investing into product, services, human capital, whatever it is, as long as the return is there, share prices tend to do pretty well. So very excited for Meta, very excited for their shareholders and our customers. The other big one yesterday was Microsoft. And I do have something to share with everybody regarding Microsoft's earnings, pulling up all that data here on the phone right now. And Microsoft, they are topping 4 trillion in market cap. They're joining Nvidia in this exclusive club. As of today, their share price is climbing quite a bit. The software giant, meaning Microsoft, reported better than expected quarterly results and said the Azure, the cloud business of Microsoft's annual revenue topped 75 billion just from that. That's pretty cool. So they are in the $4 trillion club. Microsoft shares are up a little bit more than 5% or so here as we're delivering this content. Microsoft reported 18% revenue growth, its fastest rate of expansion in over 3 years. Of course, driven by that Azure cloud computing business that was just mentioned. Microsoft did disclose that Azure revenue in dollars for the first time. Obviously, that impacted their share price, and says sales from Azure and other cloud services exceeded 75 billion, up 34% from the prior year. And Nvidia and Microsoft are the two biggest beneficiaries of the artificial intelligence boom so far. Apple, I'd say, would be third. But we'll see what happens with their future earnings as well. But if you're driving revenue growth to that magnitude in something like the cloud business, for Microsoft being Azure, that is a margin expansion story there. So that's definitely getting shareholders excited. So again, this is a pretty prominent position for our customers. Very happy to be a shareholder of Microsoft. I use their products every day, as most businesses tend to do. But now they're wrapping around even more of a moat of their business, not just software, not just Word and Excel and the classic stuff that made Microsoft great back in the 90s. Now they have cloud. Now they have a whole bunch of ways to drive revenue for their shareholders. So I'm very excited for them. And it does not appear that the spending and the investing in AI, meaning chips, data centers, and everything involved around that space, which is both industrial and technology as well as energy, I don't see where that spend is going to be slowing down anytime soon, given the results that Meta and Microsoft have produced with their investments in AI, specifically. Um, not just the artificial intelligence, but how to use that application to drive revenue. And that is what everybody's been waiting for. That's exactly what everybody's kind of had their throwing their hands up about. With all these tech giants' share price accelerating over the last several years, with all these AI dollars being spent. Well, the real question was, well, where's the ROI? Well, now you're finally starting to see some of that. And we're at the very early stages of that. You're going to get even more tonight. Like I mentioned, Amazon will be reporting today their earnings after 4 p.m. So I'll be watching that very closely. It's going to be like a little mini Super Bowl for me. I've been a big Amazon fan for a long time, of course, with having kids. You use the Amazon stuff quite a bit. And I do think that they have an amazing product and service, and their mode of safety is not just selling, products on a website. They have a cloud business as well called AWS. I'm very excited to see what that is and what that looks like. That's the biggest driver of revenue growth for Amazon. So, given that Microsoft had just excellent numbers there, I'm very, very excited to see what Amazon has to share regarding their AWS growth. And that's probably going to be the story regarding the headlines tomorrow morning when we wake up. Yes, it will be important for them to beat top and bottom line revenue, earnings per share. That matters for sure. But really, where the margin growth story is going to come from is going to come from AWS, the cloud, just like for Microsoft. So I'm very, very in tuned to that part of their earnings announcement today. Again, after the market closes at 4 o'clock. So a lot to look forward to there. And then, of course, tomorrow, being August 1st, 7 months down, but that is tariff deadline day. So you're starting to see some countries, Mexico, I just saw this before we kicked off today's program, is getting a 90-day pause to continue negotiations there. It seems as though there's going to be some sort of agreement that I don't have a lot of details about just yet regarding China. So hopefully that's been progressing nicely. Two biggest economies in the world certainly don't need to be shooting themselves in the foot. Let's just find a way to get some common ground here and move forward in a positive direction. So, the more news like that comes out certainly is going to be a driver for the overall stock market, and I do expect more and more of that as we get through the summer months leading into Q4, which we're not quite there yet. And I'll have a lot more to say about 2026 as well as the last quarter of the year once we do arrive there. But like I said, right now we're right in the middle of earnings season. And this is the biggest week of earnings season. 163 companies reporting. We'll still have a little bit more earnings to get through over the next couple of weeks as we wrap up this particular earnings season. And then we won't have much to talk about for pretty much a month. The Fed does meet up in Jackson Hole, Wyoming for a meeting. They'll talk about the economy and inflation. They may or may not signal what they might do in their actual full official meeting, which doesn't happen now until September. And that's exactly where this conversation is going to is yet again, the Fed meeting yesterday is something that we have to cover as, and thankfully I had something else to do, which was go take my family to a Reds game. So I didn't actually watch the presser this time. I just read all the articles and all the coverage for it. But that was okay for me. I think I needed a little break from Jerome, even though I'm going to talk about it here right now. So let's get to this information here real quick. So before the Fed announcement yesterday, we did get some data regarding job openings and GDP. And GDP is really what stood out here as we kick off some of this important macroeconomic data that certainly applies to the Fed and things that they pay attention to and helps them make decisions one way or another. So GDP, this has been something that's been talked about quite a bit all year long. And Fed Chair Powell yesterday in his presser actually reiterated the fact that the economy is slowing. So these are two things that are in conflict with each other right away. Okay, before we even get to the inflation stuff, which was obviously important to talk about here. GDP, that was a negative number the prior month. It came in at negative 0.5. So everybody's like, oh, yeah, the news got it right. All this policy stuff coming out of Washington is going to destroy the economy. It's going to spike inflation, destroy jobs, and get ready to just give up. We're not seeing that. So GDP, 3%, 3% expansion. That's major, major driver of growth here. Economists were looking for 2.3%. So again, this is a blowout number, big time, and it's certainly a good thing. Now, the initial jobless claims. Economists were looking for 222,000 initial jobless claims. That came in lower, came in at 218,000, and pretty much the exact same number of what we had the prior reading, 217,000. So lower being good. That's a good thing for sure. The personal income rose in the month of June. It was a negative number last month. Personal income was negative 0.4%. Economists were looking for a positive 0.2 this month. It came in at 0.3. So that's great. So growth in the economy is accelerating, showing the GDP. So that's in direct conflict with what the Fed chairman had to say. He thinks the market will slow due to this policy. And secondarily, people are getting more money in their pocket. The personal income number month over month is higher. Certainly a good thing. When you look at the PCE index, which is the Fed's favorite measure of inflation, that came in line as expected, 0.3 month over month. That's exactly what the economists were looking for. The core PCE, which is really what they pay attention to more than the headline PCE number, but core month over month, again, came in line, 0.3. That's exactly what economists were expecting as well. Now, the year over year number is unchanged from last month, but it is a little bit higher than what economists were hoping to see. Core PCE year over year, they were hoping to see 2.7. Last month, it was 2.8. This month, it came in at 2.8 again. So I wouldn't call this a trend of accelerating, even though that is what you're seeing in some news articles here today. I do not see it that way. You will have some bumps in the road regarding the last mile, if you will, of inflation. And that has everything to do with the two biggest components of inflation, that being shelter and autos, having the longest lag effect, specifically shelter, which is still coming down, but it could come down faster. And it would certainly be beneficial for those rates to come down, given the Fed themselves in yesterday's presser admitted that they are, quote, modestly restrictive. My follow up question would have been, well, what is your definition of modest? Because to me, everyone else in the world is looking at this situation and they're cutting interest rates for whatever the reason. And the Fed is saying, and I'm going to quote some of their own language here from that press conference, that they're still data dependent. I'm having a hard time seeing where they're data dependent. You know, everything is suggesting that Fed Chair Powell is certain that he's right about the path going forward here with the policies coming out of Washington, D.C., even though the data is in complete conflict of that over 7 months, right? There's just no inflation to be had here in 7 months. Now, maybe they're right. Maybe between now and their September meeting, we're going to get 2 more reports on jobs and inflation. So we'll see. But right now, the rest of the world seems to have got it right, except for right here in the United States regarding monetary policy. And again, I think when we talked about this in our last podcast, which we got a lot of really good feedback about, by the way, I don't really think it's too much the individual, although I do think that these two individuals, Trump and Powell, clearly don't like each other. And it's very unfortunate when you have those two people specifically with the powers that they have, and the fact that they really can't do anything. Like Fed Chair Powell doesn't have to listen to Donald Trump. Donald Trump can say whatever, and Fed Chair Powell doesn't have to do it. You know what I mean? Like there is no holding anybody to the fire here. So they can kind of do and say what they like to do, and that's what's being played out here in the news and the media. What's unfortunate is if you're in that position and you have to answer these questions and so forth, just do the right thing as opposed to the thing that pisses off the other person. And that's really what's going on here. And it's very unfortunate for the American consumers because we are paying higher interest than we would otherwise have to on things like autos, mortgages, etc. And with interest rates coming down, it's certainly going to be beneficial for our own budget here in the United States, paying less on our own debt. But I do want to get into some of the very specific things that Fed Chair Powell had to say. So here we go. The Fed can keep interest rates steady while waiting to see if tariff policy pushes up inflation, Powell said. Quote, higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. Our obligation is to keep long term inflation expectations well anchored and to prevent one time increases in the price level from becoming an ongoing inflation problem. So he's still holding tariffs as the reason why he will not cut interest rates by a meager 25 basis points. And in his own words, which we'll get to here in a second, is modestly restrictive. I'm going to not cover the stuff with the renovations regarding the Fed and the visit that the president had, although that was pretty good live TV for those that had a chance to watch it. And if you did, it's definitely something to go to YouTube with.
Oh yeah, go to
Uh,
YouTube and watch it. Just like you were saying, you two people that clearly just aren't on the same page,
no.
and it's the most awkward thing I've seen in a while, and I thumbs up that so many times it kept showing up.
Oh, for sure. It's worth watching. Now, there were two dissenters in the Fed's meeting I wanted to cover real quick before I keep getting into what Powell had to say. So, two governors basically did not vote. And the reason why is because they were clamoring for a 25 basis point cut. Obviously, that's not what happened. And here's what this article has to say about these two dissenters. So, the two dissenters in the Federal Reserve's meeting clearly explained their arguments to cut rates, said Powell. Powell goes on to say, quote, "This was quite a good meeting all around the table where people thought carefully about this and put their positions out there. You want that clear thinking and expression of your thinking. And we certainly had that today, I think, all around the table," unquote. Seems like he was pretty nervous to answer that question. And the reason why is the first time in 3 decades that you saw a couple people dissent on a vote. Now, I will say that these two people are probably jockeying for the Fed's job, potentially. You don't really know what's going on behind the scenes there. But I would appreciate the fact that the Fed isn't just doing groupthink here anymore. There's at least a couple people that are open minded enough to not just blindly follow Jerome Powell down this path of, well, tariffs are going to cause these problems. At least these two, and they've been late. I'll say that. It's not like from day one, they were like, nope, we're not going to vote on this because we believe that this is not a healthy thing for the U.S. economy. They were going along with Powell for a long, long time. So I'm not holding these two out as some sort of golden standard of the future path forward for the Federal Reserve and whoever the next chairperson woman may be. But at least they had the cojones to not go along with the group think. And again, this hasn't happened in 3 decades at the Fed. So I don't think he was very excited to have that happen in the meeting, and it certainly left him open to a lot of questioning from the media audience here. Now, economic growth. I mentioned that earlier. We just had a 3% GDP growth here with the macroeconomic data. And here's what Fed Chair Powell had to say about that. Economic growth has moderated in the first half of this year, but the Federal Reserve is well positioned to respond to potential developments, Powell said. And he goes on to show that growth in the first half of 2025 slowed to 1.2% compared to 2.5% last year. The moderation in growth mostly reflects a slowdown in consumer spending. We just kind of covered all this information. So, again, this is in direct conflict. So, he's looking at data from the past, and you're still stuck on this data dependency conversation, even though the data itself is suggesting that they're too restrictive. Here's what Powell had to finish up with about growth, though. Quote, "We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments." And regarding the two dissenters, that was Bowman and Waller. Um, Bowman joined the Fed as well as Waller roughly right around the same time that Trump's first administration uh, walked into the White House. And they're going on to say what really threw cold water on the market late yesterday. It was a really good day. Of course, it usually is a good day leading up to that 2:30 presser by the Fed. But then one of the last questions was regarding the next actual meeting, which is in September. And here's what Fed Chair Powell had to say. Quote, "We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all our information we get as we make our decision." the Fed is going to remain on this data dependency path, according to Powell, which is very unfortunate. Um, they left all the language unchanged regarding inflation. I mean, this is just a copy and paste from all 7 meetings that they've already had, pretty much since the Trump administration won the election last November. It's just weird and it's very unprofessional in my view. And I don't necessarily think it's all about Jerome versus Trump, although there certainly is that dynamic. I think that the entire process, and we covered this in our last podcast, the entire process of the way in which the Fed operates and makes decisions, I think should be scrutinized. I think should be looked at. Um, you could say it was Powell. You could have said it was Janet Yellen. You could have said it was a lot of different Fed people, but that haven't got it right all the time. But in the most recent examples here of history with the Fed, it's just been awful. I mean, they missed the whole 40-year high inflation thing with transitory language, right? That was a huge problem that had to be dealt with. And then, of course, as we come to the other side of that, now we just have two men in prominent positions that just don't like each other. And that's, to me, I could be wrong. We're going to find out here when we get to September. We're going to get, again, two more inflation prints. We're going to get two more job prints. All the numbers have been awesome. All right. And then you're going to be going into Q4. You're damn near, 2/3 of the way through the entire year. And you're still going to hold on to this idea that we're going to have to continue to wait for the tariff stuff to actually cause the inflation that Powell continues to persist will happen, or that it will actually cause jobless numbers to go up when in fact we're seeing them go down. You're going to be almost through an entire year and you're still going to be holding that shield up of tariffs are the only reason why we're not cutting interest rates. So we have to wait and see. It's going to be a major, it's going to be a leg. It's already, in my mind, killed his legacy. He probably had a chance to fix that coming out of the pandemic and getting the transitory inflation thing wrong and everything else. But now he's wrong on both sides. Too late to raise rates, too late to cut rates. It's just going to be uh, unfortunately, a phrase that I think is going to be stuck on him his entire life. It's too late, and I don't think that's going to work out so well for him uh, post his Fed tenure in May of 2026, compared to what other Fed governors likely did after their leadership role at the Federal Reserve. I mean, it's a very prominent position. It's an honor. It's a very difficult job to obtain, and it's very unfortunate. And I think that you will see some regulatory action by Congress potentially to take a look into some of this, but we'll see. I am not I wasn't looking for a rate cut yesterday. I would have been pleasantly surprised. It would have made me so happy. And I would have had a lot of work to do for our customers because I'm looking to rebalance as we approach what I think will likely be the first Fed cut of 25 basis points in their September meeting. Hopefully, they signal some of that when they get to Jackson Hole in August. So we'll all be watching that, of course. And of course, I'm going to have to cover it here as well. But to leave the audience without some historical information here, I think would be remiss of us as. So I do want to do that before we get off this today's podcast. So we've had a great, excellent start to the year. Again, 7 months in the books here as of the end of today. So here's what history has to say. In the first 6 months of a calendar year, when the S&P 500 is positive, somewhere between 5 and 10%, and this year it was about 8% in the first 6 months of the year. Under those historical precedents, the back half of the year, the last 6 months, tends to do quite well. It's usually positive about 89% of the time, and the average return historically is 6.1%. These are averages, and this is history. So, like I mentioned before, anything can happen. History is no guarantee of any future results, and investing does involve risk, including risk of loss. However, if we were to assume that we're going to get somewhere around the average, and first of all, if you're a long term growth investor and you're seeing 89% probability of success, even if you haven't participated in the first 6 months of the year, that's not a guarantee, but it does put risk reward in the proper context. Well, history says that I should be a winner about 90% of the time under these circumstances. Okay. So I can kind of cancel out some of the noise that I'm hearing on the day to day news, because that's all it is. One day they're super excited about something, and the next day everything's going to go to hell. Okay. So just understand that that's how the news operates. So now we have that historical context set aside. Well, what could we do to take advantage of that? Knowing that the market tends to average a positive return about 89% of the time, that's really strong. 6.1, really good. Specifically, when you compare that to the whole average of the S&P 500 over a very long period of time, the market tends to average right around 10%. So if you can get like an average expectation against an average, could be higher, could be lower. But if you were just to assume the average, well, you're basically getting 60% of the long-term performance of the S&P maybe within the last few months of the year here, right? Should get you excited. What could you do to put yourself in a position to capture that? Well, of course, you can just buy the market, obviously. But what we do here at Shepherd Wealth Management is we customize the portfolio, we tailor it to the individual, and we will concentrate it when necessary and diversify it when we think that there could be some more volatility. So we were diversified, we got concentrated, meaning that we owned fewer and fewer positions as the sell off happened over 7 weeks, mid February through almost mid April. If you missed all that, definitely go check out Shepherd Wealth Management podcast. Around that time, we covered a great amount of historical data. We did actual things based on that data that has led to our clients outperforming the market by about 13, 14% here year to date. Okay. So our clients are very, very happy. It has little to do, like I said at the beginning of the program here, it has very little to do with me and my team being super smart and better at analyzing things than everybody else on Wall Street. That's not the answer. That's clearly not true. But what we have identified is a process that removes that emotional piece that Warren Buffett always talks about as the number one reason that you don't get the results you probably should get consistently over time is you don't have a process for that. Well, we've done that by looking at this correctly through a historical lens. Now what? Well, in Trump 1.0, the sectors that did the best in order, overall market did great, but in order, tech, consumer discretionary, financials, industrials, top four performing sectors. We concentrated heavily in tech and consumer discretionary during the sell off. We had exposure to other sectors. We sold those sectors and bought that. And that's the big reason why we've outperformed in such a huge way this year already. But now we're going to look to do the reverse. I'm going to take profits away from tech and consumer discretionary, specifically in IRA accounts, because I don't need to trigger a taxable event today for customers. We'll look at that scenario as we do quarterly reviews with them every quarter, and we'll get into Q4 stuff. So it'll be a perfect time to talk about tax planning and maybe rebalancing there as well. But for IRAs, keeping everything tax sheltered, that's the bulk of our business here. We can take profits away from consumer discretionary and tech while still being exposed there. We do want to have exposure to those sectors, no question about it, especially all the data that we just provided you regarding the earnings for these big tech names. I don't see that slowing down. But I do want to take profits away from that. And I want to do two things. I want to add to manufacturers, industrials. And the reason for that is I think you're just going to continue to get more and more clarity regarding trade with other countries. On top of that, I do expect Fed rate cuts at some point in this year, which is not a bad thing for a manufacturer. But more importantly, as you project out over the next 6 months into 2026, I think you'll continue to see more and more clarity. But the big one that gets me really excited about wanting to own a manufacturer or something in the industrial space right now, or very, very soon for our customers, because we don't really have much of that right now. But what we're looking for or looking forward to is the deregulatory aspect of the bill that was passed. Yes, lower taxes is going to help out that industry as well, but the deregulation component of it, all the red tape stuff, it's just being removed so they can make investments quickly and then retroactively expense those is going to be a game changer for the sector. So I'm very excited about that. I do want to overweight it at some point coming up here. And then the last thing, like I said, I do expect some rate cuts. The fewer cuts they do this year, the more rate cuts are likely coming in 2026. And history says small caps generally do very well in that environment. And if you're looking at something like the index of small caps, the IWM as an example, the Russell 2000, within that index, of course, you're diversified across all 11 sectors in these smaller names. So they're going to cover, every 11 sectors in the S&P, just smaller companies that are publicly traded within the index. But half of that index roughly is broken down into two compartments. 35% of that small cap index is smaller manufacturers in the industrial space. And about 15% of that is financial. So think smaller banks. And that's obviously places that we want to be. I expect rates to come down. Should be a benefit to both sectors. Rates coming down for banks should mean loan demand goes up. And that's, of course, a driver of profits for financials as well. But we've had exposure there. Might not add too much there. but we are looking to rebalance, and those are the places that we're going. There's individual names that you can fill in there. You can look at ETFs or even mutual funds. That's not something that we spend a lot of time on because we do enjoy individual stock ownership. But you can have an individual portfolio of individual stocks without owning all 500 in the S&P and not really put yourself in a position of um, too much losses on the downside, but you're certainly putting yourself in a position to capture a lot of upside. Now, again, this is something we do professionally for our customers. I have a lot of background and experience. You can go to shepherdwm.com and check out a whole bunch of information about myself and our team. But we're using all this historical data to set aside the emotional piece because I'm a human being too. I don't like to see red numbers on the screen either. I don't want to get too excited when things are going straight up. But I do put things in the proper context in my brain when we look at things from a historical perspective. And it's certainly worked out great for our customers. And we'll have a lot more to share regarding the historical data that I just rattled off there. Hopefully, that's very helpful. We'll have more and more of that every time that we get on this podcast, about every 2 weeks. So I'm very much excited to get some more information regarding inflation and jobs over the next several weeks as we get into a new month of August here. But last thing to note here is Amazon earnings tonight. Expect fireworks. Expecting fireworks from Amazon tonight. So I want to hear about AWS and I want to hear about their investing for AI and how that may or may not help them drive more profits and revenue for Amazon and their shareholders. Those are the two key things I'm looking forward to tonight. And then we'll do this again in about 2 weeks. So we'll be right around the middle of August, basically back to school time for sure. And we'll be completely done with the earnings season. So we'll have a lot to talk about regarding this particular earnings season, the overall numbers, results, what percentage of the S&P was doing great, what sectors. So it's going to be a lot of fun. So I hope you'll be back with us in a couple of weeks here at the Shepherd Wealth Management Podcast. My name is Joshua Casey Garland. He's Ezra. This is the team at Shepherd Wealth Management. My business partner, John Ashcroft, is in town here as well. We really love to work for you. This is something that you're finding helpful and valuable. Ways to get control over your own investing, your emotions, hopefully more consistent, better results. This is the place for you. We'd love to speak with you and see what we can do for you. My number is 513-630-2664. And hope you guys have a great summer, great rest of your Thursday here as we wrap up the month of July. And we'll see you guys again in August. Have a great rest of your day.